Hey guys, welcome to my channel. In today's video, I'll be sharing with you another one of my favorite strategy, and that will be the calendar spread. So I will say that the calendar spread is actually one of the more complex strategies that require a lot more attention, especially once you enter the trade, because there are many ways that the trade could go wrong. So in today's video, I'll be sharing with you in detail how I enter, exit, and repair my calendar spreads. And I have also included a section on the important things you need to look out for if you decide to enter a calendar spread trade. Hopefully you'll find today's video useful, so let's get started. So the calendar spread is basically a two-legged option strategy. For me personally, I actually call this the mountain strategy, and I'll explain why in a bit. So the calendar spread can be a bullish, bearish, or neutral strategy depending on how you set up the trade. To enter a calendar spread, you basically sell a nearer dated call or put option and at the same time buy another further dated call or put option with the exact same strike price. So let's say if I want to enter a calendar spread on CVS, I would sell the call that is expiring on the 6th of August, strike price of $83, and at the same time I will buy a call that is expiring on the 13th of August, strike price of $83 as well. So the next question you might ask is there a difference if I enter a call calendar spread versus if I enter a put calendar spread? I will explain this in the coming slide. The next thing to note is that the calendar spread is actually a theta positive trade, which means that time decay is in your favor. So remember, nearer dated options decay a lot faster. So for the calendar spread, because you are selling the nearer dated option expiring on the 6th of August and buying the further dated option expiring on 13th of August, the net of the time decay for the calendar spread is actually theta positive. So you make money as time passes. Later on when I do a demo on Thinkorswim, hopefully this will give you a better understanding. And last but not least, for those of you who have been following my weekly options game plan, you would have noticed that I don't usually just enter a single calendar spread for a particular trade. So in the next few slides, I will share with you how I tweak my calendar spreads to make it into a true mountain strategy. So this is what the P&L chart looks like for the calendar spread. You can now see why I call this the mountain strategy, because if you deploy a calendar spread correctly, it actually has a very wide profit zone like a huge mountain. You can also see that the calendar spread have a very good risk to reward ratio. I'll be explaining this in detail when I do a demo on Thinkorswim in the later part of this video. So how do I normally enter a calendar spread? So for the nearer dated option, I will usually sell the option that is expiring in 2 to 3 weeks time, and that's because the time premium decays the fastest. And for the further dated option, I will usually buy the option that is expiring 3 to 4 weeks out. So for me, I always like to enter the calendar spread where the expiration date of both options are 1 week apart. So remember in the earlier example on CVS, I would sell the call option expiring on 6th of August and buy the call option that is expiring 1 week later on the 13th of August at the same strike price. So I only enter calendar spreads on stocks with weekly option chains. And the reason why I choose 1 week apart is because, remember, for the calendar spread, you are buying a further dated option and selling a nearer dated option to offset the cost of the further dated option that you just bought. So if the options for your calendar spreads are 1 month or even 2 months apart, this means that the further dated option that you are buying is going to be a lot more expensive than the nearer dated option that you are selling because of the additional 2 months of time premium. And you won't be able to offset the cost as much, and you will need a lot more capital to enter this trade. And this essentially means that your risk to reward ratio for the calendar spread won't be as good. This might sound a little confusing. Don't worry about that. In the next part of the video, I'll be doing a demo in Thinkorswim to explain this. Moving on to the strike price, if you recall in the previous slide, the P&L chart of the calendar spread looks like a mountain, and the strike price that you select actually determines the profit zone of the calendar spread. So if you are bullish on the price for the next 2 weeks, you can always select the strike price that is much higher than the current price of the stock. And if you are bearish for the next 2 weeks, you can always select a lower strike price. So for me, I always make sure that for whichever direction I'm trading using the calendar spread, for the strike price that I select, the key support and resistance level falls within the profit zone. Because then there is a high probability that the price of the underlying stock will not break past the key support and resistance level and will stay within the profit zone. Again, I'll be doing a demo in Thinkorswim in the next part of this video. And last but not least, should your calendar spread be a call calendar spread or a put calendar spread? Frankly speaking, there isn't really a difference between the two. I would say that the cost of entering a call calendar spread versus a put calendar spread should be more or less the same. So the P&L chart for both of them would actually look very similar. You can choose to enter either one that is cheaper, but just a personal preference, I usually prefer to enter the site where the call or put I'm entering is out of the money. And that's because I want to avoid any early assignment on the nearer option that I sold, which could potentially disrupt my calendar spread trade. When I do a demo on Thinkorswim, I will explain this in detail as well. So for this particular demo on Thinkorswim, I'll be using the stock CVS. So if you take a look at the daily candlestick chart of CVS, so we have to identify the key support and resistance level. So looking at the candlestick charts over here, you can see that the support level, I would say, is hovering around the $79, $80 mark. So you can see here that this has been a strong support level. It hit here once and second time over here. And also, this happens so to be the 100-day moving average, which is the line yellow. So I do expect this price level of $79, $80 to be a key support level for CVS. And moving over to the key resistance level, so the nearest one I can identify, and that would be the $85 mark over here. So this is likely going to be the next key resistance level for CVS. So earlier on I mentioned in my slide that whenever I choose, or based on whatever strike price that I choose, I want to make sure that my key support and resistance level, which is the $80 mark over here and the $85 mark over here, actually falls within my profit zone. And that's because I want the stock to actually fluctuate within this range between the $80 and $85 range for the next 2 weeks, and that's when I can get my max profit for the trade. So let's just keep the key resistance and support level in mind, and later on when we take a look at the option chains and the P&L chart, you can see why I decide to choose this particular or particular strike price. So moving on to the option chain for CVS, if you recall in my earlier slides, I did mention that for my calendar spread, for the nearer dated option, I usually select the contract that is expiring 2 to 3 weeks out. So 2 to 3 weeks out, you can see here 6th August will be one of them, or the 13th August. So how do I actually go about deciding which contract to select? So if you look at the right hand side of the platform, this is actually the implied volatility of the stock CVS for the different contracts. So typically for contracts that are further out, the implied volatility actually increases. But if you look over at the chart here, you can see some abnormal patterns over here. You can see that on the 6th of August, the implied volatility actually spiked up before coming back down again. So there's only one reason that can explain why there's a volatility spike on the 6th August contract, and that's because there's some key news or earnings release on that particular week. So that's why there's a huge volatility spike before it comes back down again. So remember, for the calendar spread, you're actually selling the nearer dated option and buying the further dated contract. So if you are selling the nearer dated option, naturally when you sell, you want to have a volatility that's much higher. And when you buy, you want to buy the contract that has a much lower volatility just because of how the Vega works. So for this case, it's very clear that I will actually select the 6 August contract to sell, and then I will select the 13th August, which is 1 week late apart, contract to actually buy. And this is actually one of the ways I actually play my earnings gameplay. One of the option trades that I do, calendar spreads on earnings gameplay. So 2 to 3 weeks prior to earnings, I'll actually enter calendar spreads on the particular stock. And if you look at this is actually a very good kind of setup because it naturally fits how the calendar spread is set up. You're selling the nearer dated option, which has a much higher volatility, and buying the further dated option, which has a much lower volatility. So if you look at the trades over here, let me go down all the way. So if you recall just now when we look at the daily candlestick chart of CVS, the key support level is actually around the $79, $80 mark, and the key resistance level is around the $85 mark. So right now, prices are actually sitting very nicely in the middle, and I will just select the strike price of $83 as a start. So for the calendar spread, I will sell the 6 August one. So in this case, I'll just select the call first, okay, and subsequently I will buy another one that is on the 13th of August, same strike price of a $83, and you can see here that my calendar spread is set up very nicely. And just for demonstration purposes, I will also do the other side on the put leg, just to see what's the difference between the two. So same thing, I will do on the 6th August, I will sell the $83 strike price put over here, and then I will go ahead and buy the 13th August $83 strike price over here. Okay, so right now you see that I have two calendar spreads over here. Both are strike price of $83. The difference is one is a call and one is a put. So right now you notice that to enter the trade, actually both of them have a significant difference. It cost me 29 cents to enter a single calendar spread using a call calendar spread, but it only cost me 17 cents to enter the put. So I suspect this is because it is after market hours, so the option price is actually a bit wonky. So but when the market opens, you should see that both of these values should be pretty similar. But just for example, I will just add both of these option chain over here. So this is actually the P&L chart for my calendar spread. So right now I actually have two calendar spreads selected. One is the call calendar spread and the other is the put calendar spread. So for the purpose of this demonstration, I'll focus just on the call calendar spread. So if you look at the P&L chart of the call calendar spread, the pink line actually represents my P&L as of today, which is the 25th of July. So even though today is a non-trading day, and the green line over here actually shows how my P&L chart will look like on the 7th of August. So that's the really good thing that I like about Thinkorswim, because you can actually visualize your profit and loss very nicely on the Thinkorswim platform. So why the 7th of August? Because my nearer dated contract actually expires on the 6th of August. So this green line actually shows me what my P&L will actually look like if I held my call calendar spread all the way to when my nearer dated contract actually expires. So if you recall in my earlier slide, I did mention that for calendar spreads, they are actually theta positive trade. So the time decay actually benefits you. So the time decay, as time passes, you actually benefit from the time decay. So if you take a look at the simulation over here, take a look at the pink line. As time passes, you can see that the pink line moves closer and closer to the green line. And on the 6th of August, the pink line will actually look like this, like a mountain. And on 7th of August, it will actually look on like the green line over here. But in reality, you can never really capture the entire profit over here, $50 over dollars over here. And that's because there are many other factors that can affect how your P&L chart actually looks like closer to expiration. So in the later part of this video, I actually explained to you some of the things that you need to watch out for that may cause your P&L chart to shift significantly, and that's something that you definitely have to watch out for. So if you look at this, on the 7th of August, let me just shift the break-even prices. Okay, so on the 6th of August, on the day that my nearer dated contract actually expires, to be able to make any profit from this trade, the price of CVS have to fall between $79.71 over here and $86.36 over here. So if I want to make any profit for this call calendar spread that I've entered, prices need to fall within this region. And if you recall in my earlier slides when we took a look at the daily candlestick chart of CVS, one of the key support level was around the $79.80, and the key resistance level was around the $85 mark. So this actually falls very nicely within my profit zone. That's because with the key support level here and the key resistance level here, there's a very high chance that prices will actually remain within this range, at least for the next 2 weeks before the earnings are released. So definitely this is one of the opportunities that I will likely enter because this falls very nicely within my profit zone. Okay, so if I take a look at the difference between the call and the put calendar spread. So recall in my earlier slides, I did mention that there isn't actually a significant difference between the two. But right now, you can see that there's a significant difference between how much it costs for me to enter the trade, 29 cents for the call calendar spread and 17 cents for the put calendar spread. And I suspect it's because it's after market hours, so the option prices are a little bit wonky. So let's say, for example, if the market really opens at such prices, so how do I tell or how do I decide which particular trade to enter? So if you look at this particular call calendar spread, right, my max loss for the trade is actually the cost to enter my call calendar spread, which is 29 cents or $29 over here. And my max profit that I could potentially gain from the call calendar spread, even though it's not really possible, is actually the green line, which is around the $94 mark over here, $98.21 over here. So my risk to reward ratio is I risk $29 to get a potential maximum of $98.71 over here. And for my put calendar spread, I am risking $17, which is the cost to enter my put calendar spread for a potential gain of $99.66. So in this case, should I enter the call calendar spread or the put calendar spread? Definitely the put calendar spread because it is cheaper for me to enter the trade. When I enter the put calendar spread, it only cost me 17 cents. And if I enter the call calendar spread, it's going to cost me 29 cents. And the risk to reward ratio for the put calendar spread is definitely a lot better because I'm risking $17 to get $99. So this is how you actually determine whether you should enter the cheaper option. And because right now both of them are actually at the money, so it won't affect if I enter the call or put because either of them are actually out of the money. So if you look at this, I will just go with the cheaper option, which is the put calendar spread over here. So if you recall from my earlier slides, I also did mention that for my calendar spreads, I usually enter the contracts that are 1 week apart, and there's a reason behind this. So right now I'm going to show you if I were to enter my calendar spreads that are more than 1 week apart. So if I go back to the ad simulator trades, so same thing, I will still sell the 6 August contract because that has the highest volatility over here. So I will sell the $83 strike here, and I will move on to buy another contract that is 1 month out. So maybe the 3rd of September over here, and I move all the way down. Same thing, I will buy at the strike price of $83. So right now you can see here that I have the additional contract here, selling on 6th of August and buying on the 3rd of September, strike price of $83. So if I go back to the risk profile of this, okay, so just a quick recap for my 1 week apart call calendar spread, it cost me $29 to enter the trade. So it's a risk of $29 for a potential gain of $98.21. And that is about a risk to reward ratio of 1:3.5, okay, 3.4, 3.5. And if I were to take a look at the calendar spread, call calendar spread, where it's 1 month apart, so I'm selling the 6th August and buying the 3rd September. So it cost me 82 cents to enter this trade, which is also the max loss for the trade, and I could potentially gain $139.29. So that is about a risk reward of 1.6, 1.7. Yeah, so if you compare the two particular trades, which one will you enter? Definitely the one with the shorter dated long contract, right? Because this has a higher risk to reward ratio. You are risking $29 for a potential gain of $98, which is a risk to reward ratio about 3.4 to 3.5, versus if I selected the calendar spread that is 1 month apart, I'm risking $82, which is the cost to enter the trade, for a potential gain of $139.29, which is a risk to reward about 1 is to 1.6, 1.7. So definitely I will stick with the call calendar spread that is 1 week apart. And remember, the reason behind this delta is because if you go further out for your longer dated contract, it actually costs you more. It's more costly for you to enter the buy contract for this. So definitely, your net the short contract they are selling won't be able to offset the cost as much. So definitely, contracts that are 1 week apart will definitely have a better risk to reward ratio. So the next question you might ask is, what if I'm not comfortable with the current profit zone of my calendar spread? I find that it's too narrow. Is there any way that I can actually increase or widen the profit zone of my calendar spread such that I have a higher probability of making this trade a profitable one? So I'll be sharing with you guys some of the ways that I actually tweak my calendar spread. So if you go back to the earlier example on the call calendar spread, that's 1 week apart, selling the 6th August and buying the 13th August. So right now the P&L is zone is actually between $79.71 and $86.36. So if you recall in the daily candlestick chart for CVS, the key support level is actually hovering around the $79-$80 range, which so happens to be the extreme end of my profit zone for my call calendar spread. So if I were to take into account the commissions required to enter and exit the trade, so even though prices might be sitting very nicely on the key support level, I might still end up losing money for the trade. So there's a couple of ways that I can actually do to tweak my calendar spread. One of the ways is I can actually tweak my strike price. So instead of selecting the $83 strike price, I might go slightly lower to $82.50. So you can now see that my calendar spread actually falls, the profit zone actually falls very nicely for my key support level, which is around the $79 to $80 mark. But this is at the expense of my upper range of my profit zone. So now my upper range of break even is actually around $85.86. So, and if you recall in my daily candlestick chart for CVS, the key resistance level is around the $85 mark. So means that my key resistance level is also now becomes the extreme end of my profit zone. So I've sorted out the issue for my support level, but now the problem becomes for the key resistance level. So this doesn't really solve the issue by shifting the strike price. So another way that I can go about entering this trade is to enter a double calendar spread. So for those of you who have been following my weekly options trading game plan, you'll see that quite a number of times I actually enter the double calendar spread. So the idea behind the double calendar spread is actually very similar to the single calendar spread. So instead of entering just one calendar spread, you enter two calendar spreads at different strike price. And what you end up having is a P&L chart that not just looks like a single mountain, it will look like a double mountain over here. So later on when I demo this, you'll see that the P&L chart actually looks like a double mountain. So let's change this back to $83 first. Okay, so I'll go to the simulated trades over here. So I will still continue to stick with the 6 August as the nearer dated option to sell. So how do I usually select the strike price for my double calendar spread? So if you recall, when we took a look at the daily candlestick chart, the key support level is around the 79, $80 range, and the key resistance level is around the $85 range. So if I were to enter a single calendar spread, I will naturally select somewhere in between. So in the earlier example, I actually selected the $83 strike price. So right now, if I were to enter a double calendar spread, I will naturally have to split up the strike price evenly. So typically for me, for my double calendar spread, I usually enter the strike price that has around the delta of 30 to 35. So let's say, for example, if I look at the put side, delta of 30 to 35, that would be the $81.50 and the $81 put option. Or and if I take a look at the other strike price that I can enter, that would be the delta 30 to 35. So that would be the $85.50 and the $85 range. So how do I select whether I enter the call side of the double calendar spread or the put side of the calendar spread? So if you recall in my earlier slides, I actually did mention that this doesn't really matter because the P&L chart will actually look the same. So in this way, I can actually enter the call side for both of them for my double calendar spread. So I'll select the $81 strike price, enter calendar spread for this, and then select the $85 strike price and call calendar spread for this. So this makes up the double calendar spread. Or I can also enter on the put side where I enter a $81 put calendar spread over here and a $85 put calendar spread. So then I have a double calendar spread over here. But you realize that for either way that I enter, I would have one of the calendar spread that is in the money. So for the call side, the $81 calendar spread will be in the money, and for the put side, the $85 one will be in the money. So personally for me, I don't like this because as I mentioned earlier, for in the money calendar spreads, because you're selling the nearer dated option, there is a chance that your shares, your option might get early assignment, and that could potentially disrupt your trade. So I want to avoid that totally. So typically for me, what I'll do is I'll enter the side that is out of the money. So in this case, for the $81, I will choose the put side of the calendar spread, and for the $85, I will choose the call side because then both of these calendar spreads will be out of the money, and this would form my double calendar spread. So I'll go ahead and do the double calendar spread over here. So I'll do the first example first on the put side. I would sell the contract that has a strike price of $81 over here, the put contract, and I will go to the 13th August, which is 1 week later, and buy the $81 strike price of the put contract over here. So this forms my one side of my double calendar spread already, the put side. And I'll go back to the 6th August over here. I would sell my 84 call contract over here. Okay, and I'll go back to the 13th August and buy the call option with a strike price of 85. Okay, so right now if you take a look at my double calendar spread, it's already formed very nicely. So for the $81 strike price, I've chosen to the put side of the calendar spread because that's all the money, and for the $85 strike price, I've selected the call side of the calendar spread because that's all of the money as well. So if you take a look at the P&L chart of the double calendar spread, so let me just turn off this. Okay, so right now you can see that for the double calendar spread, the P&L actually have a very distinct double mountain top that I mentioned earlier, and that's because you have entered two calendar spread for this. So if I were to enter this double calendar spread, the total cost for entering this double calendar spread would be 33 cents. So it's the sum of these two, and that would also be my max loss for the particular trade. So right now, if you take a look at the profit zone of my double calendar spread, originally, if you recall, for my single calendar spread, which I entered for a strike price of $83, my profit zone was between this 79.69 and 86.38. So right now, the profit zone has actually widened quite significantly. So let me just change this, set slices, break even. Okay, so right now you can see that my profit zone is actually between $78.20 and $88.03. So very well between well within my key support and resistance level. So my key support level was around 79 to 80, and my key resistance was at around $85. So a very huge profit zone, I would say. So but this is at the expense of your risk to reward ratio for the particular trade. So if you recall in the earlier example, for my single calendar spread, I actually entered with a cost of $29, and I think the profit was around $99. So the risk to reward ratio was about 3.4, 3.5. So but right now, if you take a look at my double calendar spread, the cost to enter, which is the max loss for the trade, is at $33, but the potential max gain for the trade is around a $100. So that goes out to be a risk to reward ratio about 1:3. So as compared to the earlier example with just a single calendar spread, my risk to reward ratio is 1:3.4, 3.5. But because I've widened my calendar spread over here, the profit zone, my risk to reward ratio has been reduced to 1:3. But still a very good risk to reward ratio, I would say. So you are actually expanding your profit zone at the expense of the risk to reward ratio. So there's actually a higher probability of you making money from this trade just because you have extended this particular profit zone. So that's typically how I enter the double calendar spread. So then the question you might ask is, can I enter more than a double calendar spread? Can I enter 3 or 4 or even 5 calendar spreads at the same time? You can. So if you take a look at this particular trade, right, I've entered a double calendar spread over here, strike price of 81 and 85. If I were to add back the middle strike price of 83, you can see that this is a triple top mountain, and naturally, if the price of the underlying stock CVS falls very nicely within this center zone, I'll definitely make a lot of money from this particular trade. And the reason because of that is because if you look at the individual mountains separately, so for example, I just switch this off. So the middle mountain, the $83 strike price is over here. And if I enter the $81 mountain, it will be over on this side. And if I enter the $85 mountain, it will be over on this side. So the summary or the summation of your three mountains actually give you a very nice profit area, especially within this center zone, because all the three mountains will actually overlap very nicely in the middle zone. So your max profit is actually within this middle zone of your entire triple calendar spread over here. So the question you might ask is there any benefits of doing or entering multiple calendar spread? So one of the things that you need to consider is the cost to enter the calendar spread. So remember, for a single calendar spread, you're actually entering a four-legged options, because you enter with two legs and you exit with two legs. So you need to calculate the commissions for four-legged options. So if you enter multiple calendar spreads, this is actually one of the main considerations. So if the prices fall very nicely within this profit zone, naturally this is going to be a very profitable trade. But if prices actually fall out of this range, you might lose quite a bit of money, coupled with the commissions involved in the trade. But overall, the calendar spread has a very good risk to reward ratio to begin with. So if the trade actually has a very wide profit zone, naturally this will make a very good candidate for double calendar spread, or sometimes even triple calendar spread. So it really depends on how you want to set up the trade. There's really no right or wrong answer. So one of the things that you need to consider is where is the key support and resistance level, and that will sort of guide you on how or where should you place your strike price. Naturally, you need to place your strike price evenly. If you decide to have, let's say, 3 calendar spread, if you decide to have 4, naturally you will place your strike price evenly with the 4 strike price separately apart. So this is how typically I enter my double calendar spread. Once again, there's really no right or wrong way to enter a calendar spread. It's only up to your imagination. So naturally, you want to try different various combinations when you decide to enter a calendar spread to see which actually gives you a better risk to reward ratio. So that's it for the demo on the Thinkorswim platform. So coming back to the slides, I mentioned earlier in this video that calendar spreads is actually one of the toughest strategies to master because there are many things that could go wrong for the trade. So before I go on how to repair and exit calendar spreads, in this slide, I'll be sharing with you some of the important things you really need to watch out for if you decide to enter a calendar spread trade. So the first one is actually commissions. If you recall in my earlier demo on Thinkorswim, if I decided to enter the put side of the single calendar spread, it will cost me $17 to enter the trade. So let's say my commission is 50 cents per options contract. So to enter and exit a single calendar spread, the total commissions for the trade will be $2, $1 to enter because there is two contracts in a calendar spread, and the other dollar to close the position. So the total commissions is $2 and the cost of the option itself is $17. That's more than 10%. And later on, when we look at how to exit a calendar spread, you realize that this eats up quite a significant portion of your profit. So you really need to take into account the cost of commissions for the calendar spreads, especially if you decide to enter multiple mountains. The second important point to note is that closer to expiration, deep in or out of the money options can become very illiquid. So when the price of the underlying stock moves far away from the strike price of your option contracts and become deep in or out of the money, it can be difficult to exit the trade. And this is especially true if you decide to enter multiple mountains. So if you recall in my earlier demo on Thinkorswim, CVS was trading at $83. If I entered a double calendar spread on CVS, I would have selected the strike price of $81 and $85. So if the price of CVS moves either way, one of the contract will become deep out of the money. So for example, if the price of CVS drops to $81, my $85 strike price contract will be deep out of the money, and it will be difficult for me to exit that particular leg. And think about it, you will not just enter a single contract for calendar spreads. In the earlier example, the cost to enter one calendar spread contract is only $17, and that's essentially my max loss for the trade. So if my risk appetite is $500 per trade, or I'm willing to lose up to $500 per trade, I can enter around 30 contracts per calendar spread. 30 contracts is not much, but if your underlying option chain is very illiquid and that contract is deep out or in the money, it is going to be difficult for you to exit the trade with such large contracts. So for calendar spreads, my recommendation is to trade only those stocks with very liquid weekly option chains. So your big tech companies like Microsoft, Facebook, Apple, AMD will naturally be very good candidates for calendar spreads. The last but most important point to watch out for is actually the volatility spike in the nearer dated options. So if you recall in my demo on Thinkorswim, the reason why I selected the 6 August contract as my nearer dated option to sell was because there was an unusual spike in the implied volatility. So theoretically speaking, the implied volatility should increase for contracts that are further out in time. But for that particular week, there was a spike in implied volatility because of an earnings event. So CVS is actually announcing their earnings on the 4th of August before market open. So that's why there is a spike in the implied volatility for that week. There are occasions where the price of the underlying stock is very volatile, especially 1 to 2 weeks before earnings, and that might cause the implied volatility of the nearer dated 6 August contract to spike up more than the 13 August contract. So remember, for calendar spreads, I'm selling the nearer dated option, which is the 6 August contract, and buying the further dated, which is the 13th August contract. So I'm actually short the volatility of the 6 August contract and long the volatility of the 13 August contract. So even though calendar spreads are theta positive, I might still end up losing money for the trade if the volatility spikes significantly for the nearer dated contract. So this is something you definitely have to watch very closely if you decide to trade calendar spreads. Moving on to how to repair a calendar spread. So honestly speaking, for calendar spreads, there isn't much you can do to repair the trade if the trade goes wrong. So one of the ways you can go about repairing the trade is to add additional calendar spreads at another strike price to increase the profit zone of your mountain. I will recommend you to do this only if you have sufficient time left in the trade, because remember, for calendar spreads, your nearer dated option has a 2 to 3 weeks expiration. Also, do remember to take into consideration the points that are highlighted in the previous slide on the commissions and also the liquidity issue for deep in or out of the money calendar spreads. And last but not least, how to exit calendar spreads. So for me personally, usually when I enter a calendar spread, I will immediately enter a good to cancel order or GTC order to sell the calendar spread at a return of 30 to 35%, including the commissions both ways. So even though the P&L chart of the calendar spread looks like a huge mountain, in reality, it's almost impossible for you to hold the trade all the way till the last day of expiration of the nearer dated contract and capture the entire profit of the mountain. And the reason why I say that is because there are many other factors like the spike of the nearer term volatility that can wipe out your mountain instantaneously. So my recommendations for doing the calendar spread is not to be greedy. So I always set a GTC order immediately when I enter the trade. If you think about it, a 30 to 35% return within 1 to 2 weeks is more than a 90,000% return on investment annualized. It is actually very hard to get this kind of risk to reward ratio in other option strategies. So the other scenario when I will exit the calendar spread manually is when the key support and resistance levels are broken. So if you recall in the Thinkorswim demo, I specifically highlighted the key support and resistance level of CVS, and I made sure that the support and resistance levels fall within my profit zone so that there's a higher chance that the prices will stay within this zone. So if prices break past the key support or resistance level, there is a high chance that prices will not remain within the zone, and typically for such cases, I will just close the trade manually for loss, and sometimes if I'm lucky, for a small profit. And last but not least, I always aim to close the trade before any significant news events. So remember, there is a spike in implied volatility for both legs in the calendar spread because of the earnings or news event. So when the earnings and news are released, your implied volatility will collapse. So even though you are short the nearer dated volatility and long the further dated volatility for the calendar spread, you might think that the impact will net off each other. But remember, the vega is significantly higher for your further out contracts, which means, theoretically speaking, in an ideal situation, a volatility crush will have a more significant impact on your further dated contract. So if the implied volatility for the further dated contract falls more than your nearer dated contract, and because you are long the further dated contract, you are going to end up losing even more money for your calendar spread. And if this doesn't convince you, think about it. Typically, when news or earnings are released, there is a high chance that prices will gap up or gap down, which means that there is a high probability that they are going to be priced out of your profit zone. So for me, I clearly don't want to participate in any major fluctuations of the price or the implied volatility. So I always aim to close it before earnings or any major news event. So that's all for the calendar spread. Hopefully you have found this video useful. If you enjoyed watching this video, be sure to like and subscribe. If you're new to trading options, I would definitely recommend that you start paper trading with the Thinkorswim platform first, just to get yourself familiar. That's all I have for you today. Thanks for watching.